We're now focusing our attention on the listed fixed income space. I caught up with Conrad Wood from Momentum Asset Managers and asked for his views as to which sectors prospective investors can seek as a safe haven. And of course, that is the fixed income space.
The issue that we do have is that all of these fixed income asset classes have done very, very well last year. So one immediately wants to caution some form of sort of prudence when looking at them. However, we think the same factors that drove these outstanding returns from fixed income asset classes last year are largely still in place, admittedly with some event risk and some factors that we need to watch closely, particularly out of Europe. Maybe the Chinese slowdown a little bit, the US economy faltering a little bit, but generally it's been a liquidity and a carry play that has forced a lot of money to come into our domestic market, and so fixed income asset classes should continue to perform.
But what about the risk off play, and we effectively going to see foreigners withdrawing in leaps and bounds from our market if we continue to see chaos in the Eurozone? Would that be a fair comment?
Yeah, that's one thing that sort of keeps me up a little bit at night, is at some stage there will be D-Day for fixed income asset classes. Rates have been kept artificially low for some time now. Asset prices have been inflated by liquidity that's flowing around the world abandonedly, and these assets will come under pressure when these things reverse. There will be volatility in the meantime as bouts of news come out from Europe, but the big picture remains the same. The policymakers will do everything in their power to ensure that the liquidity remains plentiful, to give them some chance to get themselves out of the hole that they've dug themselves in, and this means fixed income assets probably continue to perform even this late in the cycle.
Is it inevitable that US bonds will fall off the fiscal cliff?
Well, nothing's inevitable. I mean, we need to look at Japan and the potential Japanification of the US economy. I mean, that's one of our tail risk scenarios. It's not a high probability scenario, but the risk does exist that we enter into a sustained period of deflation, a liquidity trap, if you like, where they just cannot get themselves out of the hole. And we've seen interest rates at decade lows in Japan with no performance from the economy and a very strong currency at the same time. So that's a risk scenario. But we think that the US is too big, too dynamic. It won't make the same mistakes as Japan. So bond yields will move up there significantly as they deal with their fiscal issues in years to come.
Inflation-linked bonds have performed very well, especially the likes of the Government Employees Pension Fund had a heavy hand in inflation linkers, and they have obviously been incredibly pleased with their performance to this point. What are the risks of going into inflation-linked bonds right now?
So they've done 13% last year. They do well in an environment where inflation is rising in a measured fashion, because it means that it's likely accompanied by stable real rates, if not falling real rates like we've got right now. So that's a double whammy for them. We're in the perfect storm for them. They're likely to continue to do well over 2012. Where they don't do well is if you have inflation topping out, coming down,
starting to go down,
and rising real yields, and that's a double whammy for these instruments. They have a high sensitivity to moves in rates. So when their rates do move, it generally can be quite ugly, and you can have capital losses in the region of 5 to 6% for them, which will wipe out your inflation gains. So it's not inconceivable.
The first interest rate hike is going to come into the
timing of rising interest rates will be quite critical for inflation linkers. We just don't think that that's in the foreseeable future. Inflation's above 6%. That means month on month from inflation, you get an uplift on these bonds that comfortably outperforms cash. Plus you're earning the yield on the bonds. So they're still very defensive and still offer value for us over 2012, even despite the excellent returns they've delivered last year.
Earlier in your presentation, you did say that you expect interest rates to start ticking up mid-2013?
Yeah, that's about right. Timing, very, very difficult. We need to normalize interest rates in South Africa, given the deficits that we run and our huge dependence on foreign capital. The environment's getting more and more competitive for foreign capital. We're not getting the slew of capital that was indiscriminate across emerging markets in the earlier part of this year and last year. It's becoming a little bit more competitive, and we're going to need to offer attractive yield to investors to keep money coming here. Our emerging market peers have all hiked interest rates already in response to higher inflation. We're lagging them, and we will need to move up in a measured fashion at some stage and just get a little bit more normal policy rates.
Conrad just manages to explain the fixed income
he does
space
very well, yeah.
so
But I
clearly
mustn't talk too glowingly about
exactly.
a fellow colleague.
Momentum.
Yeah.
We need the disclosure here.
Yeah, he's a fellow colleague. Yeah.
But there is caution there in terms of deploying cash into.
The caution is US Japanese government bonds are so incredibly low that if their economies return to any form of normality in the next 2 or 3 years, you are going to get such a hiding. Those bonds are going to lose value hand over fist. But as Conrad said, and I totally agree with him, the day of reckoning is probably a bit further out than next week. So maybe it's a year's time, maybe it's 2 years' time. But the only way you can make money on buying bonds at this level in the US is if the US becomes Japan. But then the world is in such trouble if the US becomes Japan, i.e. deflation, no asset growth, no house recovery, no expenditure, nothing. Because Japan's done nothing since 1990, 20 years. So I think you are dicing with death owning US bonds.